It is Tuesday once again, and let's talk about some trading tips for Trading Tip Tuesday. So I want to talk about how to view price. I don't see too much discussion about candles versus line chart versus Heikin Ashi versus Renko or point and figure, crazy stuff like that. Most people use candlesticks, I think, depending on what they're actually viewing it on. Stuff like Robinhood or Cash App or Coinbase will just show the line chart, which I actually prefer. Something I've grown to really appreciate over the past few years is the line chart over the candlesticks chart. Candlesticks are good if you know candlesticks, if you know candlestick patterns, if you know the one candlestick stuff, the two candlestick stuff, the three candlestick stuff. If you know candlesticks, it's great. It's super helpful. It's good to know everything about anything you can. It's good to know candlesticks. It's good to know chart patterns. It's good to know trend following stuff like Heikin Ashi, momentum stuff. So definitely encourage everybody to learn as much as they can. For me, I like to emphasize chart patterns over everything. And the line chart really helps me visualize chart patterns. It helps me see that there's something here versus the wicks. I don't know. Maybe it's just a personal preference. Maybe it's just me. But the wicks on these candlesticks to me are just so irrelevant. I don't even want to see them on the chart. If I'm zoomed in like on a 2 hour, or if I'm looking at some random alt on some DEX, I know the candlesticks are going to be a mess because liquidity is a mess. And that can often cloud what I'm trying to look for here. Is there a bias one way or the other? Is there momentum one way or the other? What's really going on here? And I mean, you can draw what I'm drawing here easily on candlesticks. To me, it's just more obvious to see this is the potential reversal zone here. There's clearly Sally the Camel had 3 humps here. There's something going on, right? I don't know what any of this is chart pattern wise, but there's some sort of fractal here that's setting up for something. You could say it has a bearish bias in both cases because it has a flat bottom, diagonal bottom. You could call this a descending triangle in this case. And then, if you look at it on the 4 hour, you can draw out a triangle and you can say, oh, then it's this instead of that. But then you're cutting off wicks here and you're including wicks here. I don't know, it just gets really messy. That's why I just prefer to just standardize everything. Just look at the line chart. The line chart just gets rid of all the noise for me. And I think more people would actually do better looking at the line chart because most people have no clue about candlesticks whatsoever. Most people are confused about wicks. Do I include them in my analysis or not? That sort of thing. So I think most people just benefit from removing them entirely. A lot of people are going to hate that answer, but that's just the truth. Another way to think about this is data capture. So I like high data capture as much as I can. I like looking at a lot of data points. There you tend to find things that are more statistically significant. You reveal market sentiment that way. You look for your edge, your risk reward, your trading position, that sort of thing. So I do like looking at daily candlesticks, weekly candlesticks, because they show things like the other day we had a tweezer bottom, which is what this is, where 2 wicks are both bought up when the second wick doesn't exceed the first. Like, you have to know that that's a thing. Obviously, if you're looking at this, you have to know candlesticks. The second thing this shows is a dragonfly doji, this middle candle here, which just means it has a long wick on one side and a shorter wick on another. So collectively, both of these signal bullish reversal type market sentiment and behavior. Now, you're not going to see that on the line chart. On the line chart, you're going to have no clue. And this is just one example the other day. When we get a drop like this, I'm always looking for this. Always. I'm always looking for any sort of reversal signs, any sort of long wicks on the daily candlesticks for this exact reason. It'll vary on the time frame. Sometimes you'll see it on 12 hour or 4 hour, depending on which alt you're looking at. But to be sure, with a high probability, I'm looking at the daily 9 times out of 10. And I do have to flip back and forth for that. Something else you can use, which virtually nobody talks about, is Heikin Ashi candlesticks. Now how these work is by smoothing the candlesticks a little bit using some math based on the open, close, and the low. So it's similar to OHLC, open, high, low, close candlesticks, just normal candlesticks, but it smooths everything out. So you can see momentum a little better than normal candlesticks. One way you can use this is with any trend indicator like the cloud. You can say, all right, I'm going to enter a position when my system tells me to, as well as when I see confluent candlesticks. Usually 3 is good enough. So let's say I see a Kumo breakout and 3 bullish candlesticks. I'm going to open a position. If I see a TK cross above the cloud plus 3 candlesticks, I'm going to open a position that are confluent with that. Something else you can use OHLC for, Heikin Ashi for, is a stop loss system, trailing stop loss system. So anytime there's a momentumless candlestick or a mini reversal, such as here, you can set a trailing stop. So we have a trailing stop here, trailing stop here, trailing stop here, trailing stop here, and a trailing stop all the way up here at around 18.5, something like that, which works really well. It is very similar to alligator fractal stuff as far as momentum and trailing stops. So it's another way to look at trailing stops. I probably prefer the fractal method, Williams fractals, because those are printed automatically. I don't have to think about it or be subjective about it. But this is another way to read the momentum of the trend and decide stop losses when you're in an active trade. So right now the stop loss is way up here, which is good because it captures the entire trade. Now if you're just trading on your indicator, in this case you'd be waiting for a bearish TK cross to close the position. My guess is this will be super late and it will not capture enough of the trade to be worthwhile. So that's why you want to use something like a trailing stop system, either with Heikin Ashi or Williams fractals or whatever you want to use. But Heikin Ashi is great for stuff like that. And we can look at it on the current weekly chart, and there's been no red candles at all. One thing this won't show very well is candlestick patterns, which often rely on colors of the candlestick as well as the shape of the candlestick. You're not going to see the multi-candle patterns here on Heikin Ashi for the most part, just because they look much different than they do on the normal candlesticks. Even though there were some red candlesticks in there on the weekly, the Heikin Ashi shows you pretty clearly that all this is bullish, and as soon as it goes bearish on the weekly, you can set your stop, right? So you just don't think about it. You just hold your position. In some ways, it's a much better trade, buy and hold trade, trend trade, momentum trade, however you want to think about that. It's a lot easier to do that stress-free than worry, this candlestick was red, this was this candlestick shape, blah, 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 especially on a weekly chart. Even from the downtrend here, green, stop loss, green, stop loss, green, there's going to be a stop loss somewhere in here. Similar to 2019, there wasn't a single Heikin Ashi candlestick that was red there on the weekly until the very end. So it captured that entire trend extremely well. One other thing I'll add is, again, with the simplified trend metrics, like a 20 SMA on the weekly historically for crypto has done really well. And again, if we're below that on the 20-week SMA, that's bearish. So you can gauge that accordingly with the Heikin Ashi candlesticks here. If we're above, we're bullish. And each of these green candles is where you'd be putting your stop. If you were short here and then all the way down, you'd get out down here. This trade worked out beautifully. Similar to the long side here, your stop losses just move up a little bit at the end here and then boom, you're out. So right now we haven't even had any red candlesticks on Heikin Ashi on the weekly, at least since 10K. So if you're long using this system, you'd be long from around 8 and you'd have a stop loss here, stop loss moving up here, trailing stop, and then you'd be waiting for that next trailing stop here on the weekly. Very similar to 2019. It's kind of scary. I haven't looked at these on the weekly in a long time, but they look very strong on the weekly for sure. Then last, I'll just say again, with this line chart, I can see stuff like in Adam and Eve so clearly on the line chart that you perhaps can't see as well on Heikin Ashi or even just normal candlesticks. Even things like, a head and shoulder, inverted head and shoulders here, potentially, whatever this mess was, you can see that a lot easier. So I definitely encourage people to learn Heikin Ashi, learn candlestick patterns, learn chart patterns. There's like 6 of each that are useful, so it's not that difficult. Double bottom, double top, head and shoulders, inverted head and shoulders, cup and handle, inverted cup and handle, diamond bottom, diamond top. There's not that many. With candlesticks, it gets a little weird and much more subjective, which is why I don't have too much faith in most of it, but it's definitely worth knowing. If you're looking for specific stuff, just knowing that this is a tweezer bottom is definitely helpful. If you're short and you see a tweezer bottom, you could say, maybe I should bring my stop down or close the position or, go flat, whatever. It helps influence your trading decisions. It doesn't necessarily help you make a trade. It doesn't give you analysis paralysis. It just helps you understand what's going on much better. And then the line chart, again, I just love it. It just cuts out all the noise, cuts out all the bull crap, and just really tells you what you want to see, what I want to see. So for that reason, for me, the line chart is king when I'm trying to determine bias or sentiment of price action.